The Vanguard Total World Stock ETF, VT, is a top long-term ETF for passive investors seeking low risk. And in this analysis, I will explain to you why that is. When investing in ETFs, depending on your strategy, passive or active, lower or higher risk, there are many different choices to make. You just simply need to know that the market is at its most efficient. In most cases, the market is accurate regarding prices. It means that actually all stocks are generally relatively well valued or fairly valued. You only achieve high and average returns if you are able to find individual stock companies, which are actually undervalued, allowing you to buy a company worth 1 million for example, 180,000, 800,000, and you already have the return in your pocket. But that is advanced investing. We are talking about ETFs that are interesting for the long term. And if you are a beginner passive investor with lower risk, then Vanguard's multi-stock ETF is very interesting. One of the crucial factors here is that the expense ratio is very low. Exchange-traded funds charge costs annually, and the lower the expense ratio, the lower these annual costs, the higher your net return. And Vanguard, because they are a pioneer in ETFs, they were one of the first. Therefore, they have relatively large funds, and Vanguard Total World is one of the largest funds. That is why it is rightly popular. As a result, they can maintain a very low expense ratio of 0.07%. I don't think you can find them cheaper than 0.07% per year. This is crucial because you simply follow the entire ETF, and that is the summary of the Vanguard Total World Stock ETF. There are so many different stocks in this that you essentially follow the global average in the market, considering the variety of options available. The number of stocks in this fund is almost 10,000, and in the past it was even more than that. Now, almost 10,000 stocks. Know that if you want to have risk diversification in your portfolio, statistically, mathematically, you should want to have about 20 to 25 stocks in your portfolio, spread across different sectors. Well, this doesn't have 20 in it, but almost 10,000, so statistically, yes, you really can't spread risks any further. That is also pointless. Actually, from 100 onwards, it doesn't have much use anymore. Only the Vanguard Total World Stock ETF is the market average, and you follow the market average in a very inexpensive way. Well, various ratios are listed here. And if you are a beginner investor who just wants to invest passively, the tip for the long term is to simply buy a monthly amount every month. If the price drops significantly at some point, and we will talk about that later, just buy a lot more. If you are an advanced investor, you definitely want to learn what the PE ratio of 21 means, which is relatively on the high side, but that is for advanced investors. The price to book ratio is also relatively high, and you need to know what the return on equity is, of course, for long-term growth. But check our website for various courses that we offer at a relatively low price. I dare say actually cheap. For a few tens, you get a complete full-fledged course. That is what our brand stands for. We stand for simple investing with confidence and genuinely help you achieve high returns, but at a low realistic price. Because investing should simply be as cheap as possible so that your net return is as high as possible. It's really that simple. The Vanguard Total World Stock is a cheap fund. Expensive funds from Robeco, Rabobank or hedge fund managers may charge over 2% annually, significantly higher than the Vanguard through the multi-stock. And the result is that they do not achieve a high enough average return. At least about 80% or even more than that, 90% of all funds do not achieve a high enough average return in the long term. It also shows how difficult it is and how good investors like Warren Buffett and Charlie Munger are, who together have achieved very impressive results. Now, this Vanguard Total World Stock has 10,000 stocks, and those 10,000 stocks are spread across different markets. A part in Europe, a part in emerging markets, and a large part is in North America. Well, there is such a thing as an ETF portfolio where you buy multiple ETFs. What you can also do is buy an ETF focused on America, such as the S&P 500, and complement it with, for example, an ETF focused on emerging markets to play more, and then you also gain more control over your positions. But again, these are all advanced strategies. Actually quite simple if you know how it works, but you need to delve into it a bit. One of the important things about an ETF, if you are really a beginner investor, is that you want to know what the holdings are, and often the top 10 holdings have a certain weighting In this case, you see the top 10 holdings, and you see here that Apple has the largest position in this case. In a riskier ETF, which we will also discuss in this video, you see that the percentage of shares of each holding in the top 10 is relatively high. Sometimes that can amount to 60 to 70%. That means that 70% of the entire fund is invested in just 10 stocks. So that creates a skewed ratio, and that top 10 can greatly determine the returns. This also explains why some ETFs achieve much higher returns over the long term. The Vanguard Total World Stock doesn't actually do that. It has a bit more positions in the larger companies: Apple, Nvidia, Microsoft, Amazon, Facebook, Alphabet. However, after that, it quickly becomes less. They have further diversification over 10,000 stocks. So the effect of an Apple, Microsoft, or Amazon is relatively modest in the total weighting, but they do play a role, of course, and it is also these large companies that are responsible for the recent strong increase of this ETF, the Vanguard Total World Stock, and it is also these companies that have relatively higher valuations, which contribute to a part of this relatively higher valuation of the price to earnings ratio. A few things you should know: what we do, and for which we provide analyses with weekly updates for just €99 per year, is offer an overview of buy and sell signals for ETFs. They look like this: sell and buy signals. What we also do is a monthly update of top ETFs, including an overview based on the quant rating from Seeking Alpha. Seeking Alpha is a great program that I have been using myself as an investor for many years. With over 10 years of experience in investing, I know what we are doing. And the quant rating actually indicates what the rating of the ETF is compared to all the ETFs within the calculation model. And there are very many of them. At the moment, the rating is a hold, and we actually find the better ETFs in the shorter term by also looking at the quant rating, but also by the valuation. So a lower valuation with strong upward potential and momentum is often more attractive. But the Vanguard Total Wealth Stock is actually just a kind of average, and it often has a hold rating or a buy rating, and not really that often a strong buy, which we are looking for. But a buy rating also simply means good, and at the moment the rating is a hold. I think it also has to do with a somewhat higher valuation at the moment. However, there are a number of interesting statistics about Vanguard Total World Stock. For example, the momentum. The momentum is actually still surprisingly good. For instance, if we look at all the ETFs, there you have the median, which is not the average, but the median. And if you look at the Vanguard Total World Stock, it had an annual return of 68% over 5 years. And that 68% return is almost double what the median of ETFs has priced. So there are many exchange-traded funds, many mutual funds, that have realized a significantly lower return than this lower risk. That is a very important part of the economy. 10,000 stocks are included, 60% of America, and that percentage is spread across the world. So you have a very low risk, or at least a relatively low risk, and you also had a higher return. So that is very interesting about the Vanguard Total World Stock. And you also have a higher return. And if you are an international investor, there are plenty of variants to be found, such as Vanguard's, which is also called Total World Stock, but with the ticker WWRL. You also have the ticker IWDA. And you have various global ETFs, as I call them, or ETFs that have global diversification. But what is interesting about Vanguard and Woodstock is simply that low expense ratio of 0.07%. You also see that the average or median cost of all ETFs is around 0.5%. There are actually only a few ETFs that have around 0.2%. And then you have Vanguard, which often has the cheaper ETFs that are below 0.01%. So 0.07 cost is really very low. That's why you also get it at A+, because it is relatively much cheaper than many ETFs. And those costs are super important for the long term. Don't forget, the lower the costs, the higher your net return. Regarding dividends, Vanguard Total World Stock does pay out some dividends. However, we are not talking about dividend ETFs here. That is a more specialized theme fund, and there are very good dividend ETFs available that achieve both high dividends and high returns, higher than the Vanguard Total World Stock, but we will discuss that later. Now, the risk is low for the Vanguard Total Wholesale Stock. For example, the standard deviation is also relatively lower than other ETFs at around 11. This basically means that you have relatively low volatility compared to the overall market. And it has to be that way because there are so many holdings in this fund that it is simply an average of the entire stock market. And now, volatility is therefore also relatively low, and the turnover is only 4%, which means that only 4% of all stocks are exchanged each year. So there are stocks that are removed from the market because they are acquired by private equity or for some other reason, or stocks that simply go bankrupt, and those are then removed from the fund and replaced by new stocks. That is one of the reasons why I make these videos. One of the best ETFs. This one is just very liquid. That means you can sell your money at any random moment. You can sell your positions in the world stock. Maybe if you have millions of shares, you can buy your money, you can buy your positions. Or if you have millions of euros in shares of VTW, then that liquidity is a problem. You can see here that the average daily volume is above 1 million. So that is very much... The total fund currently has more than 50 billion under management. That also explains the low costs. So the VTW is simply one of the better funds for long-term passive investing in a very inexpensive way. Well, another tool that we use is XRank. Besides the factor analyzer, we also use many other analysis tools, and we use them mainly to select individual stocks that outperform the general return. Also check our website, we have dividend, value and good stocks, and they all score relatively high in general return. So we are doing very well at the moment, and that has been demonstrable for about 3 years in a row. Since we started, and then we do a lot of research combined with tools to potentially select the best winners. You also see that Sexshenk gives, he has also done research of course, and he indicates that ETF risk is relatively low, but we have already established that. Now you might think, okay, nice. How does an ETF benefit me as a passive beginner investor who just buys every month? Well, if you look at 2024, the stock is already at 17%, and in 2025 or 2026, it can also achieve good returns. However, realistically, you should always look at the very long term. And over the very long term, this fund could achieve an average return of around 6 to 7% per year. And I am talking about a time horizon of 20 to 30 years. And then the 6 to 7% is, I think, realistic. At times it can be 10%. At other times it can also be significantly lower. At the moment, the stock market's elevated. We've seen this before. Saw it before the dot-com crisis. And for other crises we have seen this, such as the financial crisis. Here it was still at a price of 50. It has actually halved the fund, so the fund has decreased by 50% in less than a year. And also, if you simply invest in the Vanguard total world stock, which has a lot of diversification, 10,000 stocks, you see that such a fund can actually drop by about 50% quite easily during panic. Well, the last real significant drop was during the coronavirus crisis. And here you see a decline of approximately 30% in a period of 2 or 3 months. Also, when technology stocks were particularly overvalued and growth stocks in 2022, the fund decreased by 25%. And even today, the fund seems to be very high again compared to the historical relative valuation of the stock market over the past 100 years. But well, that is advanced knowledge. Therefore, also follow and subscribe to our YouTube channel because we have more than 10 years of investment experience. We also invest ourselves with quite a significant amount of capital. We are financially free. We help other people achieve financial freedom in an affordable way. And we know what we are doing, which gives us more context, because in our videos we share relatively a lot of information and we actually ask nothing for it. Now, that Vanguard Total World stock has risen a lot as a beginner investor, and what you can actually do to keep it simple is to buy every month. So if you buy every month, you buy when the stock market goes up and when the stock market goes down. And this way you actually capture all the declines and increases. What you can also do is wait. However, waiting can also lead to procrastination, and as a result, you can actually lose returns. So actually, from our experience, the most pragmatic way is to just start with a small monthly amount. And if you see that the market has dropped by 20%, for example, that is actually a lot. So with every 10% decline, you would basically want to invest more and more. And you also need to be especially patient. This timeline here is from 2018 to, let's say, 2022. So 4 years later. And actually from that level, 4 years later, the total return is minus 1.3%. So in 4 years' time, you have a minus 1.3% return. And this, ladies and gentlemen, is the reality of the stock market. You need to take advantage of those market fluctuations. Looking at it on a daily basis will drive you completely crazy. You shouldn't want that either. You want to invest safely. If you choose this fund, just check every month and buy more. And if you see that the fund has dropped by 15%, then that's nice, and you just buy some extra every time it drops by 10%. You just buy extra. And if you see that the fund has dropped in total, for example, by minus 50%, or even by minus 30%, or even if there is a big crash with minus 40%, yes, those are the moments when you want to invest a lot of money, but only invest money that you can miss in the very long term, because what you don't want to do is sell in panic and take a loss. While all you need to do is keep buying more when the market is low, and if there is economic growth in the very long term, then you will achieve returns. And instead of achieving a return of 6 or 7%, through this simple tactic, you can achieve a slightly higher return of around 10%. Or if you're lucky in good years, even in a relatively short time, you can achieve a return of 20% per year. However, it's easier said than done, as we know from experience. So keep your cool, and remember, Vanguard through the Wolf Stack is an ETF for beginners. Very passive investing is the right methodology here. Low costs, an expense ratio of 0.07%, and a lot of diversification in more than 10,000 stocks. Don't worry. Invest for the long term and don't look back. Just keep going.